If you're a serious investor, you don't want to go through all your taxes on every single property, right? Even for beginners, sometimes they make money, but your taxes won't dictate what you actually truly make. So we focus on the actual property itself and how it's generating money. We don't really focus on what your actual income is in the past. We don't ask tax returns, pay stubs, or anything like that. Our focus is not there. Our focus is on the actual property itself. And if you can actually show us that you can generate revenue on that property, it makes a good cash flow. That's the whole premise, is cash flow. And if it does, you have our blessing, if you will.
Hey there, welcome to the VIP Financial Education YouTube channel, where we help you go further, faster financially. I'm your host, Michael Matthey. Guys, we've got a phenomenal, really what I would consider an explosive episode to share with you guys today. We're going to be talking about private money lending. So we've got a ton of folks that are obviously in our audience that continue to come back and watch us, because we have a lot of our episodes geared towards real estate. That's my background. That's a lot of folks that are watching. That's their background. And we're always looking for, ways that we can help you guys move the needle. We talk about different investment strategies on here often. We talk about how to go out there and obtain what we call OPM, or other people's money. We talk about debt weapons. But one of the things that's out there, especially in real estate, it's how do you get the financing? How do you get the funds to move forward with the real estate projects? And there's multiple ways that you can skin that cat. There's multiple sources of funding that you can find out there. What we're really going to focus on is going to be private money lending today. And we, in fact, are going to show you how to get it, where to get it, what the process looks like, how to best use it. So once you do have it, how to deploy it. And then ultimately, we've got a very special guest here on the show today that's going to really drill in and get granular on the entire process from his standpoint, his vantage point as a private lending institution out in Southern California and the Los Angeles area. And then ultimately, he will, if it's a good fit, of course, be a potential resource for you to utilize in your real estate endeavors, whether it's for current and or future projects. And with that being said, I don't want to steal too much of his thunder, but we've got an amazing guest here on the channel today. He's coming on for the first time as a channel sponsor. We hope it's the first of many. Guys, this is going to be a phenomenal resource for you. So private money, to have this in your camp as a resource is so, so powerful. There's ways that you can go out there and get it now. You can do your own research online. But unless you have a, lock solid business plan and you've got your pitch down, to an absolute T, the odds of even getting through those doors are going to be very challenging. Going out there and getting that conventional money, obviously, you're going to have to provide all sorts of background information, tax returns, verification of income, of course. You can cold call. There's going to be local investors that, you might be able to attract that are going to be involved in your projects. But again, that's a little bit of a reach. You can develop your own network. You can go to local real estate investment associations, RIAs, conferences, and the like, and kind of pound the pavement to find folks that could really fit into your network. Or you can come to us and utilize the resources that we gather on your behalf. So what we've done is we've gone out there and developed a relationship, bringing him on the channel here that you guys are going to be able to tap into moving forward. With that being said, we've got the managing director of fortknox Capital in Los Angeles, California, Mr. David Yee. Thanks for joining us, David.
Hey, thank you, Michael. It's been a while. We've been trying to get a hold of, we've been trying to make our schedules actually work.
Yeah.
To get on those. So thank you for making this a point to actually get it in your schedule as well. So essentially, I'd love to go into a little bit more what we actually focus on, and hopefully that actually brings a little bit of nuance, knowledge to your investors that could actually potentially build a network of portfolio of real estate investments for them. Again, there are plenty of other investors out there that are always stuck at some point in some time. And the goal is not to stop that momentum, right? Because obviously the real estate boom, the real estate market goes by its own algorithm. You got to really surf the wave, right? So hopefully we can actually be of benefit to actually get them to where they want to be within the next quarter, half a year, 2 years, 3 years.
Sure. Yeah, I love that. And we're going to dive into kind of that strategy. If you don't mind just sharing a little bit briefly of your your professional background, just so our audience can kind of get to know you a little bit better. And then obviously we can dive into your firm, and what you guys really specialize in.
So I started my career in the home, the home mortgage business, right? Started off with being working for a large bank, and then gravitated to being a broker where I could utilize focusing on helping people actually get into their primary home, right? For specifically for the purposes of actually living in it. But then I actually gravitate away from that, getting more into the commercial space, and helping a lot more individuals purchase land, buildings, reconverting it, repurposing it, and actually building a good revenue stream. But with the commercial side, volume is good, but at the same token, the major volume that we're looking to focus on, which I knew where I needed to kind of dive into, was the 1 to 4 unit and the multifamily. Those are the bread and butter that most of this industry itself is actually diving into. It could be totally different. When you watch this video, it might be a year from now that things totally change. We went through COVID, things change as well. So depending on the time frame, it might be something totally different. However, what's best right now for what we focus on is the 1 to 4 unit multifamily, which means 1 to 4 unit residential properties for investment purposes, and the multifamily 5+ units above, 20, 30, 40, 100, 150, 200 units. If you're looking to do that's right up our alley.
To your point there, David, obviously none of us have a crystal ball. None of us can predict the future. Real estate is obviously its own living, breathing organism. No one could have anticipated the market being the way it is now, 2 years ago, 5 years ago, 10 years ago, and none of us obviously are able to see the future, what it's going to look like. All we can do right now is use the information we have at hand to make informed decisions. So what we're always going to recommend is everyone just be completely prepared, cover all of their flanks, especially in real estate. You want to have resources available to you. None are more important than having funding behind you. And we're going to be talking about different types of funding sources. Obviously, we've got him on here in the private lending space, which is my personal favorite. What is private lending? If there's a lot of information out there, just kind of brass tacks from a pro. What's private lending?
So private lending is basically private lending. Private lending is basically private money, right? We as a lender actually collateralize or have a bulk of money, whether it be through a fund specifically. And we actually have these pool of investors that pool their money, that want greater return on their money than their 401k or their, IRA or their, savings account, whatever it may be, right? They want to tap into the real estate market because they know it's hot, right? We've been on this trend. Interest rates are super low, right? And it just hasn't stopped for at least 8 years, right? Little fluctuations here and there, but it consistently grows, right? Which is a great thing. So with us, we have a pool of money from our private investors that have abundance of money that's looking to actually deploy that in proper segments or proper asset classes with true investors that are actually looking to purchase, refinance their own properties.
What can it be used for? Do you guys have limitations on what that can be, what that money can be used for when they come to you looking for it?
So with us, we actually focus on the core of what's actually being very hot right now in the market, right? Where we don't see a real major downturn in the market because it's trending. So we're focusing on actually deploying that money into the 1 to 4 unit investment properties right now. Okay, because right now, as you can see, if anybody knows, renting, it's never been as high as it ever was, depending on the location you're at, right? So a lot of investors out there are actually, increasing their rent throughout, especially during or after COVID, post-COVID, and it's going to go constantly go up and up and up. Why is that? Basically, because there's a lot more people that are looking to actually rent. The population is growing, or the population is being relocated to a certain area. So the certain parts of the area of the country are actually going up and up as it goes, right? Until things change, otherwise, until rates change and all that, that may actually change, right? Post-COVID, as you already know it, that a lot more people are relocating to certain areas, whether it be for a job, whether it be for, just want to live cheaper. So there's going to be pockets of areas throughout the country that you can probably rent a property for a 2-bedroom, 2-bath apartment or a home for $1,000. Now that area, because it's so hot, it might jump up to $1,300, $1,400, $1,500, maybe even more, and it will go up depending on the actual market. So if you can focus on those key areas that actually are trending, that's where you want to actually dive into. Buy low, rent high.
So effectively, you've got a group of accredited investors that are in your camp. They're pulling together their money. You guys are taking those resources, you're deploying them into certain asset classes, obviously, where they can get, those healthy returns that they're looking for. Now, we talked about, how stringent it can be to get conventional money. What do the parameters look like for private lending with your firm? How do you get qualified? How do you get disqualified? Kind of what does that process look like? And before that, guys, if you're watching and you are already interested, maybe you already have a project that you need financing for, whether you need it now or you need it in the future, that's something you want to have in your toolbox, go ahead and email David and his team. You can reach them at fortknox, that's fortknox at VIPfinancialeducation.com. Please include your first, your last name, best number to reach you, and in the subject line, include a private lending conversation. Someone from David or his team will be back in touch with you ASAP. Not to cut you off there, David, but yeah, if you could continue, I want to go ahead and give people the opportunity to reach out to you now if they know that it already may be something that they want to at least discuss.
So let me kind of give it a broader perspective and answer, because some of your views might be beginners, some of them might be totally advanced, which is great.
100%. We've got both ends of the spectrum and really everything in between.
Perfect. So everybody knows Fannie Mae, Freddie Mac, right? So Fannie Mae and Freddie Mac actually are wonderful, right? They actually have a lot of programs in place for individuals that are looking to actually purchase homes, whether it be their owner-occupied property, investment property. The downfall is, or not downfall, what's different with Fannie Mae and Freddie Mac is that we don't have restrictions, right? So they have certain restrictions on how many investment properties that you can actually purchase, how many owner-occupied properties that you can actually own. So there is a limit to what actual Fannie and Freddie actually have to offer. Private lenders like me, we don't have those restrictions. We don't care if you buy 100, 200, 300 properties, right? And that's the goal, is to get you more properties in a short period of time. And our rates are not that much different when it comes to that, right? There's a method of how you actually can utilize our money, our process, and actually acquire more properties. So one of the benefits of us is that we offer bridge lending, right? So a lot of people, as you know, if you've been anywhere in the real estate market in the past 15, 20 years, you know that there's a lot of flippers, right? Fix and flip. There's A&E, there's plenty of TV shows out there that they can say, hey, I can buy this home and fix it in $20,000. And then all of a sudden they back it up with $200,000 in value. It's a little stretch, but we laugh at those. It's, there's so many of those shows out there right now. Anyone with a hammer and a screwdriver now is a bona fide flipper. Well, it only takes one really big mistake to get out of flipping very quickly. And you're talking about those bridges, obviously, when those mistakes happen. So not to cut you off there, but yeah, we laugh about that internally all the time. Everyone out there is trying to flip these days. And it's okay. It's entertainment, right? But when it comes to you as an investor, you want to know the reality into the game, right? You don't want to get stuck into how easy it is. It's not an easy job, right? But if you plan accordingly, you can actually do a lot of damage in this market, right? So the goal is to actually acquire assets to acquire more property. How do you do that? Well, the key difference between us and what Fannie and Freddie actually has to offer is that we don't have much restrictions. Here are the things that we actually truly focus on when we actually lend money. Credit score, LTV, how much you're looking to actually put down, and your track record. Those are the three things ultimately what we focus on. We don't care if you have 15 Range Rovers on your credit report, which I've actually had somebody bring to me recently. Is that you got 2 Range Rovers and that's why his score is 700, right? I'm like, well, it's not that bad, but could it be 760, 800 credit score? Sure, why not, right? But it all depends on your spending, right? If you were going to buy something like that, maybe it's best if you actually get a business loan or a business lease, for instance. Don't you put it on your own name, right? Because the goal is in this industry, if you're actually going to succeed in this industry, you want to tailor and focus on your credit and make sure that it's always as high as possible. Why? It's not because you're going to get the best rates. It's not just because we can get you financing or not get you financed. Ultimately, the goal of having a higher credit score is making sure we verify I'm okay with actually providing a higher loan to value on your purchase. So the least amount, everybody wants to buy property, but it's all about how much you're looking to put down, right? So with a higher credit score, we are okay with going up at a higher loan to value. We can actually maximize your leverage on purchasing property, refinancing, or cashing out some of those properties, right? So the goal is to actually increase that your leverage throughout the process of investing. Credit is great and it's always going to be important, right? But another thing that you maybe it might be further from what you need to focus on right now is track record, right? So as a private lender, I want to make sure that you are actually seasoned. So if you've done 1, 2, 3, if you've done 4, 5, 6 properties in a consistent base of, let's say, 2 to 3 years, I'm going to pay a lot more attention to you, right? So we're going to be focusing on individuals that are serious, that are actually going to do a lot of volume, and not because of, you're going to make me more money. It's that I know that you're absolutely know what you're doing. If you can show me, you can demonstrate to me that you've actually done 3, 4, 5, 6 properties in the past 2 or 3 years, and they're all successful, that's great, right? It shows me that you're actually a seasoned investor. So you know what you're doing. You're not gonna bail on me. You're not gonna we're not gonna buy a property, use our funds to actually purchase that property and negate that, right? So we want to make sure that we're focused on individuals that are actually investing in quite frequently, right? And demonstrate that you've actually done some good projects in the last 2 or 3 years. Why 2 or 3 years? It's because the things change, right? Inflation of material changes. So if you're in a flipper, cost of goods might be totally different now than what it was 5 years ago, right? As you know, post-COVID, everything's more higher, right? So that changes the dynamics of what you can accomplish than what you could have done before. If you did projects in the past 5, 10 years ago and haven't really done anything recently, well, that's great that you actually have a track record for 5 or 10 years ago, but the premise is what's now. If you were playing football, for instance, you might have been a pro athlete and bring home Super Bowls, but are you doing that now? Right.
Right. 15 years later, probably not. Right.
Yeah. So are you washed up? Are you?
Yeah.
So, and I hate to use the word washed up, but we get what I'm saying. Things change.
Yeah.
Right. So ultimately, I've seen a lot of people that actually do very well. And when they actually consistently do projects and not skip a beat, because things change as far as their, people get you hired to do work for you. And so there's a lot of difference, a lot of variance.
No, tons of variables involved in real estate, of course. And, we've got, like I said, we've got all ends of the spectrum here on the channel. We've got pros in real estate. We've got people that have just started to stick their toe in the water, and we've got people that are still on the sidelines. You mentioned track record, and of course, that's obviously important from a lending standpoint. You guys want to make sure that you're dealing with someone that's going to go out there and handle the money the right way effectively, so that you guys can mitigate your losses. And that makes sense from a business standpoint. But if my folks are watching from home and they're seeing this video and they don't have a track record, but they want to get involved in real estate, or they're just starting to get in real estate and they know that they need funding like yours behind them, does that automatically disqualify them? Or do you have programs where you can work with people that are just getting out of the gate?
Correct. We actually have programs for individuals that are just coming out of the gate. Their first property. I get plenty of first-time investors. I've had tons of first-time investors that are actually just start off. Some of them actually start off quite slow and actually get really, really busy after they get the second or third deal in place. And they clicks in their head and be like, okay, this is simple. So you want to get into doing your first. Doing your first is like key, right? So once you do your first, you learn from your mistakes. Everybody's gonna make mistakes. There's no way you can't make a mistake. Everybody makes mistakes. How small, how big, right? But once you learn it, I promise you'll never make that same mistake again.
Yeah, and I love that. There's definitely something cathartic about doing your first deal. Mine was many, many years ago, as yours was as well. But there's something about that. You get that first deal under your belt, you start getting confident. And the more and more deals you do, of course, the easier it is for you to take just a quick glance at the deal, take a look at some of the math real fast, and just kind of do some calculations in your head where, without diving too deeply or going too deeply down that rabbit hole, ultimately you can figure out if there's going to be some meat on that bone that is worth pursuing, through an avenue like private lending. You touched on, your kind of terms are not too much different than Fannie and Freddie, and I know it's all on a case-by-case basis, so I'm certainly not trying to pin you down on any numbers here, David, but, what would be maybe a range of, average terms that, people could expect to hear from you?
Sure. So depending on the actual program we're looking to focus on. So if you decide you want to actually do fix and flip, right? If you want to focus on the BRRRR method that everybody talks about, right? Yeah. Whatever your goal is, you want to make sure you write down what your goal is first, because actually that's the only way you'll know what works for you, is by writing down what you're actually going to do first. And then we can custom tailor. If you talk to me and, hey, listen, this is what I'm going to do, David, what do you think? Right? I don't mind that. I don't mind chatting on the phone, giving some pointers on what you should do to actually utilize our services, or to leverage your buying power, and when you just first starting off. But for that matter, so on our fix and flips, we can go down as low as 10% down. And then we'll finance you 100% of the rehab budget. So what does that look like? So let's say you buy a property that's $200,000, right? And let's say you're putting down only 10% down, right? But just let's caveat, I'm saying 10% down because that's as low as I can go, right? With the highest credit score, and you have your track record as high, if you have a seasoned track record, right? We can go down to as low as 10% down. But the rule of thumb for first investors, they should be focusing on about 20% down on the purchase and 100% of the rehab. Okay, so if you haven't saved up them enough yet, definitely do. Okay, and just work on properties that are in your wheelhouse of what you're looking to purchase. There are properties that are cheaper, that are 50, 60, 70, $100,000 that you can actually focus on, as opposed to the higher markets that are maybe $200,000. But for argument's sake, let's say an individual first-time flipper, average credit, puts down 20% down on 200,000. That's $40,000, right? But it's okay, because we're gonna give you 100% of the rehab budget. So we're gonna pull that money 100%. So you're gonna talk to your contractor. He says, how much is it gonna take me to fix this place up to 100%, the way I like it, where it's gonna maximize my leverage, maximize my rent, right? So I don't want to put too much in, but I also want to put enough in to maximize my rental income, right? Because you're going to be renting this out, right? Or unless you decide you want to sell the property, and some of them do, right? So whatever your goal is, whatever your strategy is, you want to maximize your dollar amount, right? So let's say he says, well, it's going to take about $60,000 to fix this up. Really good, right? So we're going to put in to an escrow account for $60,000, where you can actually get dispersed or reimbursed, if you will, of the funds that you actually put in, or you invested into the property already. So some contractors, depending on how you work it with your contractor, or even your partner, for instance, whatever you put in, if you put in, let's say, $10,000 of money into the property, and you fixed up $10,000 worth of repairs, you're going to say, David, I fixed $10,000. I need to get reimbursed. Great. We'll send somebody to inspect it, make sure that $10,000 has been deployed into the property. We'll cut you a check for $10,000, whether it be you or your contractor, and then just rinse and repeat until you use up that $60,000.
Now that makes great sense there on that. So you guys you'll finance up to 90%, and then you guys will do 100% of the rehab. For people that don't have that, just 10 to 20% down, guys, that's what we talk about debt weapons for on the channel here all the time. If you've got that debt weapon, whether you've got access to a HELOC, whether you've got any particular line of credit cards, you can make up the deficiencies on that down payment utilizing that. So that's one of the great things about debt weapons, is you can use it to basically create additional revenue streams for yourself, whether it's buying a business, whether it is buying real estate, and building up, obviously, your assets. So debt weapons would be a great play to make up that deficiency in that down payment. Some people might already have the capital, and obviously that would not be applicable, but again, it would go back to OPM. So you talked about doing that with a flip. What if it's a long-term buy and hold, David? Are the terms differently on that, or?
It is a little bit. So since you're not going to actually be doing any work to the property, you're not going to gain any realized increase into the value of the property. So let's say you buy a property for $200,000. You're not going to do anything to it, and you're not going to fix anything. You're just going to actually rent it out as it is. So you buy that property for $200,000. One of the things we're going to require is 20% down. So if you're going to be actually purchasing just turnkey type of properties to rent, 20% would be actually our bare minimum. So with 20% down, we'll get you into the door with that property, where it will generate income from day one if you plan it correctly, right? But yeah, 20% down is our minimum.
Okay. Guys, if you already like what you're hearing, go ahead and smash that thumbs up button below. We love seeing a bunch of those when we release these videos. Lets us know we're on the right track, bringing great content to you guys. If you already know you want to have at least a conversation with David and his team, go ahead and send an email to fortknox@vipfinancialeducation.com. That's fortknox@vipfinancialeducation.com. Include your first your last name and your phone number in the body of the email, and private lending conversation in the subject line. Someone from David or his team will be back in touch with you ASAP. One of my personal favorites right now, David, as far as investment asset classes, is going to be a short-term rental. The VRBO Airbnb space. You and I have talked offline about that. We've got some great videos coming up here in the next couple of weeks talking specifically about STR space. What are your thoughts on that? Is that an asset class that you guys actively invest in?
Absolutely. We actually we focus on short-term rentals and actually do quite well with it, quite honestly. So there's an abundance amount. If it was actually 2-3 years ago, basically nobody was really focused on specifically with short-term rentals. The great thing about us, our program, is that we're able to actually get people in the door with short-term rentals without actually having a long-term lease in place and qualifying on the property in itself based on few criterias. And, as you guys know this space quite well. Okay. So one of the things is what we focus on is we use a couple of sources of websites such as airdna.co. We take they compiled a lot of data in the past of what specific properties in that area and what they actually generate or have generated in the past, because most of these platforms for short-term rentals, everything's calculated, right? Everything, the metadata is there. So all they need to do is look at what the metadata looks like for that specific property, and they can determine how much this property is actually generating as far as income. So there are a lot of properties out there that actually do quite well if you focus on the key areas of where people want to go when it comes to short-term rentals, little short-term vacations, if you will. So with that being said, we take 80% of what AirDNA states your yearly income would be for that property. Or if you're refinancing one of your Airbnb properties, we would take your last 12 months of your income, of generated income, and we actually take 80% of that. So we don't care about what you spent and whatnot or all your other expenses. We just tax it by 20%. We reduce it by 20% to focus on that, because quite honestly, if you're doing real estate right, you're investing it right, you're probably writing off a lot more than that, right? So we as a private lender, we know that whether it be your short-term rentals or your long-term rentals, we know that you're gonna depreciate and write off a lot of expenses for that particular property, especially for your first few years. But we don't tax you on that. We don't hit you on any of that specific. We don't look at your expenses on the property. We just focus on what your taxes are, what your insurance is, and if it's if it's within an HOA, we look at what your HOA is. So from that, those three key elements of your three expenses focus has a lot to do with everything else, right? And it's going to be a lot less burdensome when we actually qualify that property, because we're not looking at your tax returns. We're not taking off what your net is looking like, right? So we look at just specifically the property, what it generates, and what are your expense, your three major expenses, or I should say four, because you have principal and interest as well. So those four key elements itself will dictate everything.
So what I'm hearing is that you guys, whether it's a short-term, a short-term rental, whether it's a long-term buy and hold, whether it's a fix and flip, you guys, they can find a home there and get financing for those projects through you guys. What type of projects do you not want to see come across your desk? Are there some out there that have too much hair on them? Just so if people are watching, they say, hey, I potentially have this project. but I'm going to go ahead and eliminate myself because David said, those are not projects that they specifically want to look at. Do you have maybe one or two of those that you would not, entertain?
Sure. So I would probably say that I would stay away from. We're not a venture capitalist. I get emails all the time with inquiries of venture capital, or specifically private equity. We get a lot of inquiries about private equity, and that's not what we do. We don't actually offer it. We don't actually partner up with specific investors to go in and actually do a specific home investment or anything like that. That's not what we do. We're just strictly a debt lender.
Got it. Okay, and that's a really important for people to understand the distinctions between the two. When you hear hard money, institutional, conventional, private lending, private equity, a lot of those can be really confusing to folks. I think that you've done a really good job of kind of mapping those out today and giving us the distinctions and giving our audience the distinctions on those, David. We always like to talk on the channel when we bring experts on like you. Who's a good fit for your program, and who wouldn't be a good fit? Who should be watching right now and say, this is right in my wheelhouse. Let me go ahead and reach out to David and his team and talk about next steps moving forward. Or if they're watching, who would you say, this is probably not in their wheelhouse and maybe it would be spinning their wheels?
Sure. If it was 5 years ago, I would probably say if you haven't actually done a fix and flip or purchase a property in the last few years ever, or even ever, I would probably say we wouldn't be a fit for you, right? However, things have changed. Private money has been a lot more easier to actually acquire nowadays. Obviously, and potentially not at the highest leverage of most people think, oh, I want to buy an investment property for 0% financing. 100% financing, right? Yeah, not going to happen.
If you guys have that program, I'm all in right now. I can tell you, customer.
I'm sure I would too. I'd be like, yeah, let me change my profession. Let me actually get into doing this full time just along with you. But yeah, we get actual beginners all day long, consistently now, more and more for the last probably about the last 3 years. Okay, got a lot more beginners, and they all start off with us, right? They could actually go with Fannie Mae, Freddie Mac, and all that stuff. But here's the reason why they actually chose us, is that we don't verify income. We don't really truly verify assets, where the money came from. You mentioned about debt weapons before. We don't care where the money came from. Okay. We want to see that the money's in your bank account. However, we want to make sure that you're not embezzling money. We want to make sure that it's not coming from overseas and all that stuff, which is fine as long as it's documentable, documented correctly. But other than that, all we care about is making sure that you can come to the table with the funds that you need to purchase that property. You'll have enough reserves in place. So if any hiccups arise, we want to make sure that you actually have some sense of collateral in your bank account just for the rainy day. But beyond that itself, investors from, no properties whatsoever to as much as investors that, they don't have time to actually purchase property, go through 30 to 60 days and go through their tax returns. If you're a serious investor, you don't want to go through all your taxes. It's like on every single property, right? And you're going to be obviously limited. Even for beginners, sometimes nowadays, a lot of you have money and you make money, but it's your taxes that won't dictate what you actually truly make, right? So we focus on the key areas of we only focus on the actual property itself and how it's generating money. We don't really focus on what your actual income is in the past or what it is in the future. We don't ask tax returns, pay stubs, or anything like that. So that's a key element when it comes to the benefit with us is that we don't care about any of that stuff. I wouldn't say we don't care about it, but our focus is not there. Our focus is on the actual property itself. And if you can actually show us that you can generate revenue on that property and it makes a good cash flow, that's the whole premise, is cash flow. And if it does, then you have our blessing, if you will.
Yeah, I think that's important to know. So, it's not just kind of a blanket statement where, if this, then go ahead and disqualify yourself. Sounds like you guys have different entry points just based on experience, based on credit. Obviously, there's going to be a range of terms, and that's going to be with any lending, guys. It doesn't matter if you're going to Fannie, Freddie, you're going to fortknox Capital. There's going to be a range, and it's going to depend on your specific situation. What I love about the private lending, though, is that they're more focused on the actual asset itself. And then it's a math problem, guys. And we talk about math here on the channel all the time. It's just taking the data, and this is a very data-driven industry. And at the end of the day, if you guys crunch those numbers and it makes sense, then you can put a deal together with them. So if you're watching, you don't have to have 5, 10, 15, 20, 30 deals under your belt. Now that's going to help your cause, obviously. But if you're just getting started, don't disqualify yourself because you don't have those deals. Reach out to David and his team. At least have that consultation call with them. Doesn't cost you a nickel. And see if it's a good fit for you, good fit for them. Usually that can take place within the first 3 to 5 minutes. People can find out, and David and his team can find out whether or not it's worth additional conversation. And then he'll obviously share with you what next steps will look like at this point. David, I appreciate you sharing that, guys. We love bringing content like this here on the channel. If you're not a subscriber already, go ahead and subscribe and ding that bell notification below. That's going to give you the heads up as we bring additional information here on the VIP channel, like David and his team. So thanks for joining us, guys. The VIP Financial Education, where we help you go further, faster financially. Until next time, take care and make it a great day.